Hello and welcome to Your Money, Your Call. I'm Julia Lee. It's been a huge day on the stock market, although not a lot of volume going through with Melbourne Cup Day. But we did see the Reserve Bank interest rate decision and rates on hold, surprising a lot of economists in the market. If you have a question about shares, rates, or perhaps the US election, our phone lines are open. We're ready to take your call, so please give us a call. The number's 1300 30 34 35, or if you prefer, you can also email us on yourmoney@skynews.com.au. Tonight on the program, I'm joined by David Buckland, CEO and Portfolio Manager at Montgomery Investments, and also Carl Capalingua from Australian Stock Report. So, gentlemen, welcome to the show. I mean, it's been a big day, and I think maybe we'll start off by talking about interest rates, the impact they have on the Australian share market as well as currencies, and what you foresee before the end of the year. We've seen the Shanghai Composite down by 16% over the last 52 weeks, and the material space down by 12%, compared to the S&P 500 over in the US, which is actually up by 13%. So it looks like the way the Chinese market goes is the way that our miners go. I mean, are you looking at this space at all? Are there bargains in this area?
Julia, I'd have to say we're very cautious about the space. We had a very aggressive negative call on iron ore 12 months ago when it was $180 a tonne, and we said it could actually halve, and it has halved. Clearly it's bounced from about $90 a tonne to $120 a tonne, but we think the highlight of the growth in China over the last 20 years is more an aberration than normalcy. And what's happened is that with the magic wand being waved on infrastructure, the Chinese have been able to increase their production of steel from about 600 million tonnes to about 850 million tonnes, and so we think there's a massive amount of global oversupply, and hence the Australian materials sector will continue to generally do it very tough.
Okay, so staying away from the materials sector, it sounds like, for the time being, and it sounds like a lot of people have been in defensives all year. When they talk about investing in the Australian share market, a lot of that money is going into defensives, and certainly we've seen stocks like Telstra up by a massive 30%, and that's not including the dividends. Stocks like CSL up by 61% over the last 52 weeks. I mean, you don't expect these type of returns in a bull market usually for the defensive areas, but you know, in this type of market, they're doing fantastically well. So, David, are they starting to look expensive? Are you still interested in this area?
There's certainly many of these counters I think are very, very much at the expensive end of the spectrum. And the reason is, Julia, is that clearly there's a move into these high dividend yielding paying stocks. But that is not a very smart thing to do if those stocks don't demonstrate strong earnings growth. I'll give you an example. National Australia Bank 10 years ago was $32. Today it's $25. So it's fallen by about 30 percentage points in 10 years in capital terms. Now, people could have bought it 10 years ago because they said it's a high-yielding stock. But from a capital point of view, it has been a massive disappointment over the last 10 years. And now one of the reasons is because its intrinsic values have gone sideways at best, but most importantly, its underlying operations have performed relatively poorly compared with its three competitors. So one must look at the underlying earnings growth of a particular business over a long period of time and not take a 5-minute view on the yield. And
we've got our first caller on the line. So, Brett, welcome to the show. What's your call for our panel tonight?
Oh, hi, Julia. Mine's regarding Imdex. Supplies to chemicals and the drilling for the oil and gas sector. I'm just wondering if David could give me the intrinsic value and his rating on the stock. And I know Carl probably won't get too excited about it technically, but if you've got an opinion, that'd be great.
Okay, sure. So we're having a look at Imdex, and its historical dividend is 5.5%. Its PE ratio is down actually at 6 at the moment. And I guess this is the reason why we've seen Brett call in about the intrinsic value of the stock, because while the PE ratio on its past earnings is 6, the past earnings have been quite good. We've seen EBITDA up by 56%, revenue up by 36% in 2012, or the full year results that we just saw coming out to the market in October, and the dividend actually increasing by 61%. But as you can see, a lot of those metrics looking good because the share price has tumbled. So, David, what's your view on this?
Well, at Montgomery, we rate Imdex an A1 stock, which means it's got a superb balance sheet and it's been a very good historical performer. Our intrinsic value on the stock is around about $2.20, so we would argue that there's a fair bit of upside. The problem I have with this one, Julia, and it's like a lot of stocks in this sector, its forecast intrinsic value over the next few years is not rising. And we only want to buy stocks where we see a good, an intrinsic value that's rising at a very good clip, i.e. there's good prospects for a particular business. Now, the big problem with some of these resource service companies are that at the end of the day, they're contractors, and once those contractors fall off, they may be very difficult to replace with such high margin type business that they've had in the past.
But David, I understand that for mining services companies which are servicing the bulk area like coal, like iron ore, but this is mainly oil and gas, and we've got some massive projects here in Australia and from some of our big oil and gas
That's right, but I
well.
do feel that it is somewhat linked in sympathy with that particular sector. But, you know, I do think that from our point of view, it does offer much higher share price appreciation than many that we've talked on the show in the past.
Okay, so I guess it's not just the oil and gas industry, but the whole mining space, which this particular company, Imdex, looks at. Next call, I've got Glenn on the line from Sydney. Glenn, welcome. What's your question for our panel tonight?
Yeah, hi Julia. My question is regarding SDL, Sundance Resources. I understand David might not be able to help, Carl might have a view, but you may have a view yourself, Julia, on this. I know that, I'm just looking at a short-term trade. They're currently trading about 36, 37 cents. They've got the offer on the table to buy the company at 45 cents. I know that, it's been a long-running saga. It's been over years that they were offered, 50 cents, and that was, went on, and 57 now it's come back to 45. But the way I understand it, it just needs to get the shareholder approval. I'm just wondering your thoughts there. Thanks.
Sure. So a good question coming through from Glenn. I won't say too much because I actually own Sundance shares. It was very disappointing to see the offer price from Hanlong dropping from 57 cents down to 45 cents. But of course the key around this has always been the financing, and now the financing from the China Development Bank as well as Everbright Bank are coming through, and that's more than what's needed for this particular takeover bid. A few hurdles, but a world-class resource, it's going to take probably about close to $5 billion to develop, and that's really why they need someone like Hanlong to come along to inject some capital here. It's good to have seen prices stabilising from the bottoms that we saw back in August at $87 and now about $120.
Correct.
Are you positive on iron ore stocks? Is this one?
No, we're not.
No, that was a very quick answer.
No, we're not. And in this case, poor balance sheets, capitalised at $1.1 billion. It obviously needs a massive amount of development capital.
Absolutely, yeah.
For me, it's sheer speculation.
And on that note, it is time for a quick break. But before that, it's time to start the stock watch. So, David, what are you watching?
I'm watching Codan. Okay, at Montgomery Fund, we like Codan CDA, the world leader and producer of metal detectors. It's capitalised at about $400 million, and at the latest annual general meeting, they said their earnings would be up by over 40% for the year to June to $40 million, which puts it on a PE of single digits. Most importantly, it's got a return on equity of 40-odd percentage points and a superb balance sheet. We think Codan has a lot of upside from here.
Welcome back to the program. If you've just joined us, David's stock watch was CDA. Codan was the stock that he had as his pick this week. If you've got a question you'd like answered, please give us a call. The number's 1300 30 34 35, or you can also email us at yourmoney@skynews.com.au. And we've got a caller on the line, Luke from Brisbane. Luke, welcome. What's your question?
Yes, how are you, Julia?
Great.
Just a short-term to medium-term outlook on Woodside.
Sure. So Woodside Petroleum, I mean, this is one where we've seen production going in its favour now. Pluto's started to kick in, looking pretty good. But on a short-term basis, I mean, it's really quite hard to pick where Woodside is going to go. I mean, David, this is a stock that's been coming out with earnings upgrades, which is always good to see. So production upgrades as well as earnings upgrades. But
yes, but it's about expectations. And see, this stock's declined from over $65 to $35 in the last 4 years. So that's, it's more or less nearly halved in 4 years. And, our intrinsic values just are not rising. They're below the current share price. So we do not own Woodside and won't own it.
How far below the current share price?
We would say that this stock could quite easily trade in down another $10.
Yeah.
And that's based on the earnings profile?
That's based on our estimate of intrinsic value, which assesses things like earnings profile and puts a particular discount rate on the earnings profile, i.e. the reliability of the earnings.
Let's go to our next caller. We've got James on the line from Sydney. James, welcome. What's your question tonight?
Yeah, hi there, guys. I'm interested to hear your thoughts on AVQ, which is Axiom.
Sure.
After your thoughts on the technical analysis and also if you've got any information around where they might be heading in the future. They've got a couple of strong projects on the books, one of which is pending a court case in the Solomon Islands at the moment. So just wanted to get your thoughts on the charts and any recent news.
Okay, so having a look at Axiom Mining, and as our caller mentioned, there is a court case pending. So James mentioned that there's court case pending in Solomon Islands. They're also involved in Vietnam as well as here domestically in Australia. And David's chuckling away there. Why are you laughing, David?
Well, it's got 1.3 billion shares on issue. It's selling at 2 cents. Its market capitalisation is
40 million.
Yeah, I was going to say less than $28 million or something like that. And the big problem is it is a profit. It's a continually profitless business. So the reason I'm laughing, Julia, is because to me it's sheer speculation, and you've got to really know some great detail as to whether you want to invest in something like this.
So David, it's an exploration company, so it's understandable that it doesn't have earnings, it's burning cash.
Yes.
So for those punters out there that do like their small cap mining exploration type of companies, is there any hints or tips that you can give them to help them navigate their way through, I guess, the large number of mining companies that we have here in Australia, which are, coming up with cash flow?
Well, my major tip is that generally the distance between exploring and production is a massive distance, in that most of the time it always takes longer and it always takes a much bigger spend than anticipated.
That's very true.
Okay, and if it takes shorter or takes less spend, that is the absolute exception rather than the rule. So my argument is that you basically buy these things just as they're going on the cusp of production, after they've disappointed the market, which inevitably 9 out of 10 of these companies do. So there's disappointment, but they're on the cusp of producing. So in toll road terms, it's a bit like opening the toll road and the cars per day are massively down.
Like with connections.
Are massively down on expectations or on budget. But if you're very, very confident in the long-term story, that's the time to say, all right, the spend's behind us, the road's built, the people are coming. It's just, it's massively disappointed in the short term.
Okay, so that's a good tip coming through from David around exploration. Our next caller, we've got Ken on the line from Brisbane. Ken, welcome. What's your question tonight?
Thanks, Julie. Could the panel tell me what they think of Silverlake Resources for holding it for the next couple of years?
Sure. So we're having a longer-term view on Silverlake Resources. SLR is the code there. The Mount Monger project as well as Murchison. What do you think of this one, David?
We like this one, Julia, and I should declare that both Montgomery Fund and the Montgomery Private Fund are shareholders in Silverlake. Big increases in gold production. They'll end up being a very low-cost producer, and I think the earnings will grow very, very, very aggressively over the next 18 to 36 months on the back of that dynamic.
Okay, so liking Silverlake Resources,
we like it very much.
On the back of its production profile and the fact that it's low cost?
Both.
Both of those. So 2 ticks in the favour of Silverlake. Let's go to an email now, and we've got one here from Ed. And Ed asks, can I please get a fundamental analyst or a fundamental view on 7 West Media and AWE Limited? So let's start off by David. 7 West Media, what do you think?
Well, I think it's
look at that stock chart. It's
been diabolical. In fact, if you go back 4 or 5 years ago, I think it was as high as $16, Julia. So it's gone down the lift well. $16 down to approximately $1. Its return on equity now is 5 or 6 percentage points, which is, you may as well have your money in the bank. And I think at $1, it's more or less selling at intrinsic value. So, to be honest with you, I think there'd be dozens and dozens and dozens of more exciting businesses to be in. I mean, operationally, it's well positioned, but it just has a poor return on equity, and it sells at probably a little more than its intrinsic value, and it's hardly exciting.
And David, the problems, the old media assets, as we call them, the old Western Australian News, which was incorporated into this area, the large amount of debt, we saw capital raising for this company.
Yeah, combination of two things.
Do you think there's any prospect for a turnaround in terms of the business as well as the share price?
Yes, of course there's a prospect for a turnaround, but I think there's many more exciting opportunities. Yeah.
Okay, so better opportunities elsewhere in the market. And we've got Dave on the line from Queensland on Mesoblast. Dave, welcome. What's your question tonight?
G'day, Julia. Just inquiring about Mesoblast.
Sure.
Just wondering if it might have a bottom there at about 550. Got a lot of stuff in trials. Got a fair bit of cash in the bank.
I mean, stem cell research that actually works, but the share price is certainly not working in its favour. What do you think, David?
Don't like it, Julia. So it's capitalised at $1.6 billion. It has $200 million of cash. You're quite right, it does have a half-decent balance sheet. The problem, Julia, is that it lost $70 million in the year to June. Its forecast loss for the year to June 13 is another $50 million. Its forecast loss for the year to June 14 is, call it $60 million. So the question is, will it run out of cash and have to raise more money before it actually starts, in the road analogy, start getting traffic down the road, and it'll be a race. And I think as shareholders, it's better not to bet on the side of doing it as quickly as everyone hopes, because tradition would dictate that it takes slower and longer than many people anticipate.
Deep breath.
So technical's not good, fundamentals not good.
It is in the speculative fund part of my portfolio, and it has been a fun ride until now.
At $1.6 billion, it's capitalised
it is quite a big
as a pretty serious business.
Absolutely, and there was some serious funding in place. So unfortunately, both our panellists not liking Mesoblast. MSB is the code there. We've got an email now from Andrew, and Andrew from Newcastle asks, please let me know what's happening to Emeco. I bought it at 70 cents and it's now at 61 cents. Is it still a strong company? And is its return still good, or should I sell? I mean, we've been talking a lot about these mining services companies that have been hit hard. Emeco also being hit hard. Is this one that... do you like this one, David, at all? Earth-moving equipment, once again in that mining space, has been hit pretty hard.
Yes. Look, the good thing about this business is it actually earns reasonably serious money. In the year to June 2012, it earned about $68 million. And the forecasts over the next 3 years are roughly that again, 60 to 70, maybe even $80 million. The return on equity is low double digits, so pretty unexciting. The balance sheet is not in great shape, I'd have to say. It's got indebtedness of about $457 million. It's got cash in the bank of $73 million. So it's got sort of net debt of about $380 million, which is quite a lot, I think, for a business that's highly operationally leveraged. And I don't think you need to be highly operationally leveraged as well as financially leveraged. That said, our intrinsic value is a bit above the share price, but we're not really keen on this sector.
Let's go to our next caller. We've got Ben on the line from Brisbane. Ben, welcome. What's your question tonight?
Thanks, Julia. Just directed to Carl, just like his opinion on Titan Energy. It's been bouncing around between 1.8 and 2.2. Just wondering if you can see it getting over there, considering they've got money coming in from their drilling in next door to Maverick, and they're also about to start their oil gas play in Perth Basin. So,
okay, so having a look at Titan Energy, we're looking oil, coal seam gas.
It hasn't made $1 in 10 years, and I don't know if it's going to start.
Okay, and we've got Greg on the line from WA. Greg, welcome. What's your question tonight?
Good evening, Julia. My question is about Magellan Financial Group. I would like the panel's analysis of the stock and a point of entry, please.
An amazing stock and an amazing stock price run. I mean, up 200% in the last 52 weeks when other fund managers are struggling to get money in through the door and in fact are seeing net outflows. This is a stock that's been, this is a company that's been winning mandates left, right and centre, and it looks like more money flowing in through the door in the first quarter, David. I mean, what do you think of this one? Has it run too fast?
No, well, Julia, I should declare that Magellan Financial Group owns a small percentage of Montgomery Investment Management, the business that I'm the CEO of. Now I've made that declaration, I should say that I feel that Magellan Financial Group have an ability to replace Platinum over the medium to longer term as the leading Australian domiciled international fund manager. And as Julia was alluding to, they've just won a mandate from a large London-based institution for £1.5 billion, which is approximately $2 billion. Their current funds under management are about $5 billion. That'll take them to about $7 billion. Platinums are currently about $16 or $17 billion, and I think that gap will close over the next 5 years, in which case Magellan will then see massive operational leverage on those increased funds going from $5 billion to $7 billion to one day, $10, $15, $20 billion. And what happens is that these businesses are set up so you don't actually have to add a lot of extra people, rent, etc., etc. And what happens is your top line increases very aggressively, and then that just drops straight into your earnings line. And I feel that although the stock has run very, very aggressively and is obviously extremely vulnerable to pullbacks and extremely vulnerable to bear markets, I just feel that they are in a very, very good place. And I think that they could challenge Platinum as Australia's leading domiciled, sort of domestically domiciled international fund. Could I just add something for context?
Sure.
Platinum's market capitalisation is about $2 billion, and Magellan's is about a third of that. But Magellan also has a very rich balance sheet in terms of cash and investments. So if you deduct that, they're probably valued at around about a quarter of Platinum. So that just gives you some context of what could occur if they end up closing that gap between the 5 or 7 billion and the 15 or 17 billion. What it could do for valuation purposes.
An email now. We've got an email here from. We've got an email here, and the email says, "Hi Julia, please can you ask the team what are their thoughts on the following stocks to buy: United Group, Bradken, Metcash." Love the show. Keep up the good work. We don't have a long time left on the show, so let's just get your favourite out of these three. David, if you had to pick one, which one and why?
I'd probably go for Metcash, Julia, just because its reliability of earnings would be much higher than the other two.
So thanks so much to our guests tonight and to you, our viewers, for all your calls and your emails and for tuning in. Until next time, I'm Julia Lee.